Hello and welcome to the June 2016 Downtown Pittsburgh IBD Meetup presentation. My name is Eric Rossi. I'm a co-organizer of this meetup group. And if you're not already a member or you found this video on YouTube directly, there's a link here to the meetup group's homepage. So the mission statement for the Downtown Pittsburgh IBD Meetup group is to educate individual investors about the CAN-SLIM investing strategy. So this presentation assumes that you are familiar with the basics of Bill O'Neill's investing strategy, which is called CAN-SLIM. So our goal really is to identify the best educational material from books and webinars, videos, etc., and provide that to you so that you don't have to go sifting through all this information on your own. And this presentation is for educational purposes only. None of the information here should be construed as recommendations to buy or sell any securities. Investing in the stock market does carry substantial risks, and you can lose your principal. I'm a non-professional volunteer investor, and Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily Incorporated, and Meetup is a registered trademark of Meetup Incorporated. The topics for this month's presentation, we'll do the market dashboard as always. Then we'll talk about doing a quarterly review of your trades. This is going to include an example, quarterly review from my trades. Then I'm going to talk about earnings season, which we're on the cusp of earnings season here. Then a new topic for each month here, I'm going to do an IBD feature of the month. And this will be a feature from either investors.com or from the newspaper itself. Then we'll go do the market analysis, and then we'll conclude. Okay, the market dashboard. So the big picture right now, the market pulse on IBD is in confirmed uptrend, and this just happened a couple days ago on June 30th, and it happened right after the market really sold off sharply from the British exit vote. But the market did rebound with force and volume was strong, so we are back in a new confirmed uptrend. So we get a green for that indicator. And the uptrend health, this is a brand new uptrend, so typically the bigger returns are made in the early phases of a new uptrend. So we get a green here since this is a new uptrend. There are 0 distribution days, so we get a green on that. Fed activity for the Federal Reserve. So the Fed raised interest rates in December 2015, and they're expecting more increases in 2016. Although as time goes on, it's becoming less certain that they're going to raise rates again this year, and the number of times they're going to increase rates is even less certain. But since rates are increasing overall, I'm giving this one a red. The S&P 500 right now has a C accumulation distribution rating in IBD, and so that gets yellow. The Nasdaq has a D- accumulation distribution rating, which is a red. The IBD 50, I'm giving a yellow right now, just because it's up for the year, so that's good. And no, I'm sorry, it's down for the year. But it is above both of its two longer-term moving averages on a weekly chart. So it's not really strong right now. It's not really weak. It's kind of in between. So I'm going to give this a yellow. The last bull market, well, we're currently in a bull market, which started in March 2009. We could be transitioning to a bear market right now. It's kind of uncertain at the moment. I'd say we're still in a bull market right now, but it is long in the tooth, as they say, where the longer that we've been in a bull market, the longer we keep going in a bull market, the less likely that we're going to get big returns on a lot of growth stocks. And certainly the market action right now is more choppy and sideways than anything else, which is consistent with the late phase of a bull market. So that gets a yellow. The last bear market ended in February 2009, so that was quite a long time ago. So I'm giving that one a red, because again, after a bear market ends and we transition into a new bull market, that's when the biggest returns are made in those first couple years of that new bull market. And the market, the Nasdaq, has had 9 intermediate corrections, and these are corrections in the 10 to 19% range. Anything 20% or more generally is considered a bear market. So there's been 9 of these such corrections since this new bull market started in March 2009, which is quite a lot. So that gets a red. So you can see overall we've got some green indicators now, which are really the most recently changed ones, but these longer term indicators were more in the yellow and red still. So still a good time to be cautious, and it's certainly okay to invest right now. Some people are saying that day trading is working better right now. I know I'm doing more swing trading. I'm actually only doing swing trading in the past quarter. That's working much better than position trading, which is traditional, I'll say, IBD investing, where you buy a stock and you hold it for at least 2 months typically, and you're looking for a 20 or 25% gain. Swing trading for me is working much better right now, which is going for smaller gains, like a 10% gain, and cutting losses at 2 or 3% or less. And most of the positions are being held for about 2 weeks. Okay, so we just finished the second quarter of 2016. So the end of each quarter is a good time to review the performance of your trades. And here's some questions that you can consider while performing your review. What type of trades are working best for you? Okay, if you're just doing position trades, which is, I'll say, the fundamental IBD trading strategy, then this is kind of a moot point. But if you're doing day trading and swing trading, positions, if you're doing options, anything like that, if you're doing futures, what type of trades are working the best for you? And then which setups are working the best? Did cup with handle bases tend to do better for you than double bottoms? Or did double bottoms outperform cup with handle and flat base, etc.? And then which entries are working best for you? There's standard buy points, which would be buying like a cup with handle breakout or a double bottom breakout. And then there's early buy points or alternate buy points, where you might use a sloping trend line on a handle, or you might use on a double bottom, you might use a shakeout +3. So which entries are working best right now? Did you follow your rules with each trade? And if not, then why didn't you follow your rules? If you took a loss, then why did that happen? This is probably the most important question to ask here, because by understanding your losses, you're in a position to not take as many losses, hopefully, in the future, by tweaking your strategy. And these last two are less important, but I did this just because I wanted to see how I'm doing overall. What was your average percent return per position, and how many positions were winners and losers? Now, it's not critical that you have a lot of winning positions in order to be profitable overall. You could have a couple winning positions that make really big returns that totally offset many losing positions. Okay, so the key really is, are you profitable overall? And how profitable are you compared to where you want to be? So after you answer these questions for each trade, you want to compile your results and look for trends in those results. And then I recommend creating an action plan to improve your performance the next quarter. And then after you create your action plan, track your progress, probably on a weekly basis, or at least monthly, to ensure that you're executing your action plan and to hold yourself accountable. So here are the results of my quarterly review as one example. So I made 22 trades last quarter, and 14 of these were profitable. I only performed swing trades last quarter. I don't do day trades because I work a normal job for a living, so it's hard. I've had a hard time with day trading. If I have to run away for a meeting for an hour and come back and find out that I probably would have sold my position for whatever reason. I didn't do any position trades last quarter because I'm kind of experimenting with swing trades right now, and I did go back and look and saw, what if I had taken position trades with these? In other words, going for a 20 or 25% gain and probably holding the stock for at least 8 weeks or more. And I found that swing trading did better than position trading would have done. Position trading would have only resulted in one really good winner for me based on my rules, and that was Weibo. My average return per trade was 4.1%, and alternate entries and standard entries worked equally well. The most common pattern that I traded was a cup with handle. So based on my results and by my summary, I came up with this action plan. And this is just an example. This is just for me personally, but it'll give you hopefully an idea of how you do this for yourself. So I only traded one double bottom formation last quarter, and it was the very end of the quarter. So I'm going to trade at least 2 of those next quarter, because those tend to, they have a lot more, I'll say, opportunities for early buy points, in my opinion, than like cup with handles. And this next quarter, I'm going to trade at least 2 longer term positions, 2 position trades, mainly just to stay, stay aware of my sell rules and how I manage position trades. By not doing any, I get rusty, so I just want to trade a couple like that, manage a couple positions that way. But I'm still going to be doing mostly swing trades. I've been increasing my position size slowly as I've gotten more comfortable with swing trading, and since right now I've been consistently profitable now for a good couple months, I'm going to continue increasing my position size if I continue to remain profitable until I get to a full position size of what I want to be trading for swing trades. And a couple of things where I found I took my losses was mainly due to failed breakouts and then due to action around earnings reports. So a couple notes I have for next quarter to hopefully reduce the number of losses, or at least reduce the magnitude of those losses. If a breakout appears to be failing, the day I buy it on the breakout day, and by the end of the day it appears to be failing, I want to be ready to sell before the market close. Okay, I don't necessarily need to wait around till the next day to see if the breakout truly is going to fail or if it's going to rebound. I personally like cutting losses very small, and then if a stock starts to show some positive action, I'll buy it back and I'll get back in it. That's just for me personally. You could certainly give stocks a little more latitude than I do, and you may not then have to go buy the stock a second or third time before it works out. Totally up to you. And if buying a stock after the earnings report, if I buy it right after the earnings report, I want to be ready to sell before the market close if it reverses. And buying on an earnings report, if it's a breakaway gap, then those have done well for me. If it's not a breakaway gap, for example, PayPal, I owned this stock last quarter, and I had a small gain going into the earnings report. So I sold my position, and I said, I don't want to take the risk of holding through earnings report, but I'm going to see what happens after the earnings report, and if the action is positive or neutral, I'm going to buy the stock back because I wanted to own the stock. Well, what turned out is the stock really didn't do much on earnings report, and the day after I bought it, I think the day actually I bought it, it closed low in the range. The next day it was down, and I ended up having to sell to take a loss on the position. So my takeaway is basically, if I buy on an earnings report breakout, I like if it's a gap up. I prefer if it's a gap up, and if it's not, I'm going to be a little more cautious. So those are my 2 takeaways for trying to reduce losses going into next quarter. So if you want to see my entire quarterly review, I have it in a table posted in the files section on our group's Meetup site. Okay, we're going into earnings season here. So here's some notes about earnings season. These are I'm going to go through just some of my personal thoughts and observations on earnings season. and then I'm going to do a quick book review, some good notes I got from a book where they studied earnings reports over a long period. So each quarter, publicly traded companies must report earnings, and earnings reports often cause a lot of volatility with the stocks. This is a lot of times when you see stocks gapping up or down significantly, it's usually as a result of an earnings report. So I've done this before. I did this years ago. I bought stocks right before the earnings report and then held it through it. And sometimes you can make a lot of money doing that, but sometimes you can get killed. And the bottom line is that's gambling. That's not sound investing, in my opinion. So never buy a stock right before the earnings report unless you're just willing to take a gamble and you're prepared to lose a significant amount of that money overnight. It is okay to hold a stock through the earnings report if you have a suitable profit cushion. So I like to use 15%. If I have a 15% gain on my position, I will hold it through the earnings report. If I have less than that, then I'm less apt to hold through the earnings report. Maybe I hold half the position. You could also use an option strategy, which I'll talk about later. But the bottom line is, you don't want to be holding a stock through an earnings report unless you have a nice profit cushion where you can stomach if the stock gaps down. Stock could gap down 5, 10, 15%. That happens all the time. So you just don't want to get crushed and lose a ton of money overnight. So if you do not have a suitable profit cushion, the safest move is to sell before the earnings report and then wait for after the earnings report to see what happens. And you can always buy the stock back. Okay, but there are other more advanced strategies. Like I said, I'll talk about an option strategy later. So another approach, like I just said, is to buy a stock option to hedge your position. So if you have a long position in a stock, you would buy a put, and a put will increase in value if the stock goes down. So that way, if the stock price goes down, you lose money on your position, but you gain money in your put, and that'll hopefully, they might not totally level out, even each other out, but that'll at least help hedge your position there. And if you're short in a stock, you would buy a call, so that way if the stock were to gap up, your call would make money and your short position would lose money to try to even each other out. If you want more details of that option strategy, it's discussed in the IBD leaderboard webinar from January of 2015. And this particular topic starts at about the 30-minute mark in that video. And there's a link here to that video if you want to go check that out on IBD videos. And top growth stocks do have a tendency to gap up after earnings reports, and that is true. I actually track the top 20 stocks of the IBD 50 each quarter, and overall, if you were to buy those stocks the day before the earnings report, and then hold through the earnings report, and then sell the next day, overall you would be profitable doing that. But again, it's a gamble. There's some quarters you would lose a lot of money. Other quarters you would do very well. There's no guarantees. So personally, I think it's way too risky to take that risk. But if you have a really high risk tolerance and you don't mind losing money on some of those positions, then you could certainly try holding through an earnings report without a suitable profit cushion. Okay, so some recommended reading about earnings season. This is a book called Trading on Corporate Earnings News, and it's by two authors named Sean and Zhu. And these guys basically did a study of earnings reports over a long period of time. And I don't remember how many years exactly, but it was on the order of tens of thousands of earnings reports that they studied. So these are just some of I think the best takeaways from this book. I didn't give a ton of notes here, but these are, I think, some of the better takeaways from the book. And then if you want to learn more, you can always get this book and read more about it. So a large portion of a stock's returns in a given year are centered around the earnings reports. So earnings reports do present a lot of opportunity, but they also present a lot of risk. And that's really the problem of trying to make money on an earnings report. Half of earnings reports cause market returns that are 30 times larger than a typical trading day. So if a stock trades 0.5% on a normal day, it might trade 15% on the earnings reports, okay? So half of the earnings reports cause a significant market reaction compared to a normal trading day. And about 40% of the time, the market's reaction is opposite what is expected. In other words, if there's a good earnings report, you would expect a good reaction in the stock price. But 40% of the time, a good report will yield a negative market reaction. And likewise, 40% of the time, a negative report will yield a good market reaction. Which leads us to the next point, that even if you could predict the announcement in advance, there's a good chance that the market reaction would be opposite what you expected. So that's what makes making money off of an earnings report so difficult. It's not as easy as just buying. If you knew in advance that a company was going to report better than expected earnings and sales, you might say, oh, I'm going to buy a lot of the stock the day before the earnings report. But you don't know how the market's going to react to it. The market may react negatively for whatever reason. Now, earnings announcements are reliable in the sense that they are a recurring source of information about a company's performance. And they're, with every company, every stock you own, that there's 4 times a year that they're going to report something, and the stock price is probably going to be affected in a big way. So that's one good thing, is that this isn't like a terrorist attack or some tsunami where you have no idea that that's going to happen. You know that the earnings reports are coming, so that's why it's good to plan accordingly. Now, companies don't have to provide future guidance, and that's where they would say, oh, next year we're expecting to do a 50% increase in sales and a 60% increase in earnings. They don't have to offer that information. It's not required by law, and it's totally voluntary. But future guidance does seem to oftentimes have a big effect on the market reaction, maybe more so than even the actual report, the actual earnings and sales numbers from that previous quarter. In recent years, there has been a steady decline in negative earnings surprises, and there's been a steady increase in positive earnings surprises. And despite the wealth of data available today and the skills of analysts, and really the quantity of analysts that are out there, earnings surprises are more common than ever. So despite all this technology and all the data and all the analysts looking at the data, earnings surprises are more common than ever. So if these analysts, with all their data that's available and all their connections, if they can't even necessarily predict the market reaction, as an individual investor, you're going to have a really hard time trying to predict that. In more volatile markets, the magnitude of market reactions increases. So the past 2 years, we've been in a pretty volatile market, pretty choppy and sideways, and not making a whole lot of progress one way or the other. So I don't have data to back this up, but I would guess over the past 2 years, the market reactions have been higher than they would have been, let's say, in 2010, 2009. Again, I don't have data to prove that, just that would be consistent with what the authors were stating here. And market reactions do seem to be increasing in size over time. So the market reactions are getting bigger, meaning the stock price is moving in a bigger way as time goes on. 51% of earnings reports are positive surprises. 16% of reports are zero surprises, meaning the report is directly in line with what was predicted by analysts. And 33% of reports are negative surprises. So there is definitely a propensity towards positive earnings surprises, like I mentioned earlier. If a company reported positive earnings surprise last quarter, then it is very likely, about 76% according to the authors, that they will have a positive surprise the next quarter. And the authors called this earnings persistence. So companies who persistently have a positive surprise will have a very strong likelihood of doing that the next quarter. And the market has a strong tendency to extend its reaction long after the announcement. So this is the case of, and really this isn't the author's note, this is just my note here. This is why buyable gaps are a sound play. Because if a stock gaps up on an earnings report, a lot of times they do tend to keep increasing in price as the days and weeks ensue after that. Now that doesn't always work, but oftentimes it does. So what the authors concluded here is another reason that buyable gaps, particularly on an earnings report, are a sound investing play. So the rest of this book discusses various option strategies that can be deployed during earnings season. So it's kind of out of the scope of most IBD style investing, and I'm not very savvy with options, so I'm just going to point you here. If you do want to learn more about those strategies, you can check out chapters 7 to 11 of that book. The book's available on Amazon. I know that because that's where I bought it. Okay, the IBD feature of the month. This is something new that I'm going to put in the videos each month. Just going to cover one feature from investors.com or from the newspaper each month. This is really just to keep us up on the latest features on the website and the paper. So for this month, the feature is called the Big Picture, and this is something that's really useful to look at every day, especially if you don't have a lot of time. This is a really quick way to get a short summary in 5 minutes of what happened with the market action. So I look at this every day, the big picture, and I think it's really useful. So you get a daily summary of the market action. It'll tell you if there was economic news that came out, if there were maybe there was GDP numbers came out, or maybe the Fed had a meeting where they talked about interest rates. Maybe there's certainly the British exit vote would have been covered. And then they'll talk about how the market did. So it'll say, hey, here's what the S&P 500 and the Nasdaq did today. It also has a discussion of leading stocks that are showing sound technical action. So this is a good place to get watch list stocks. You also get the market pulse, which tells you if the market's in a confirmed uptrend under pressure, or correction. And you also get the distribution day count, which tells you how much distribution there's been in the market over the past 5 weeks. And then stocks on the move tells you which stocks moved in a big way or in big volume that day. Sometimes you get a link to the IBD. Sometimes the IBD market wrap video is included on the big picture column. Sometimes it is, sometimes it isn't. If it isn't, you can just go to IBD videos, and usually the market wrap is the first video that comes up. And then the last thing on the big picture is it's called the general market indicator charts. And these are charts laid one above the other. The Nasdaq, S&P, and the Dow. You also get a couple lists of stocks that were up in big volume. So we'll go through all this for the big picture when I switch off the PowerPoint here. And I'll do that right before I do the market analysis as well with the charts. So right now, the market analysis, the market went briefly into correction because of the British exit vote, but it quickly rebounded and went back into confirmed uptrend last week. The Nasdaq has hit recent resistance around 49.70, so you want to watch the action around this value if the Nasdaq keeps going up, because it's hit this resistance point around there, 49.70, 49.80, a couple times recently. The Nasdaq did recently break through both the 50-day and the 200-day moving averages, so that's a good sign. That's a sign of strength. And overall, it's okay to own stocks right now, but you probably don't want to be heavily vested because we are in the late stages of a bull market. The market action's been choppy and sideways and kind of volatile, so it's been hard to make big gains. And it's a good idea to keep tighter stops than normal right now and to take profits sooner than normal. Like I said, I'm doing mostly swing trades at the moment. where I'm shooting for a 10% profit goal, and I'm actually using tighter stops than this, sometimes as low as 0.5%, mostly less than 2%. And I'm finding that to be a sound strategy right now, and really delivering better returns than regular position trades where you would buy a breakout and hold it for a longer period. Okay, I'm going to switch off the PowerPoint now and switch over to investors.com, where we'll look at the big picture, and then I'll switch over to MarketSmith, where we'll look at charts. Okay, this is a continuation of the presentation. I switched over from the PowerPoint to Investors Business Daily, investors.com. So to get here, I went to, again, we're looking at the big picture. This is the IBD feature of the month I just talked about a couple of slides ago. Go to the market trend, and then you click the big picture, and then you get a list of the days that the big picture is available. So I clicked on the most recent day here, and this is what it looks like. Sometimes the IBD market wrap video will be right here, and it'll come up automatically, but not in this case for whatever reason. So if you go click on IBD videos, you can find the market wrap video. And here, like I said, you get a description of what happened for the day, what was the return, the percent change of the major indices, was there any notable news. Certainly the Britain exit vote has been in the big picture a lot lately. And then you get this little summary right here. So a summary of the day's action. Market was up in low volume. What's the current outlook? We're in a confirmed uptrend. The distribution day count would be here, but since we just went into a market correction and now came into a new confirmed uptrend, the distribution day count is 0 at the moment. And then you have leaders up in volume. And this is actually where I get a lot of my watch list candidates, because these stocks would have been up big, up in heavy volume today. So I'll go look at the charts and see, are they in a base? Are they getting near a buy point? And they oftentimes are. They're oftentimes not extended, is what I find. And then leaders down in volume you can find right here, which are, I don't use this too much unless a stock I own it shows up here. But I'll if it was down in heavy volume, I'll have already known that before I saw this. So, like I said, then they talk about any reports. So there was a report about chain stores, sales. There was an ADP employment report. There was a jobless claims report. So they'll tell you anything that happened that might have had an influence on the market for that day. And then if you go to click here for these general market indicators chart page, you'll find these charts. The S&P 500 starts first. And this is where I get the accumulation distribution rating that I put in the market dashboard. But this is just a nice summary. It tells you what the index is doing for the year. You get a chart here. This is a daily chart. You can see volume. And it's overlaid right on top of the Nasdaq right here. So I mentioned the Nasdaq's been finding resistance at the 49.80, 49.70 level. You can see that clearly right here. And again, you get the performance for the year, you get the accumulation distribution rating, and if you scroll further down, you get the put-call ratio right here. This is a contrarian indicator. In other words, when there's a lot of puts being taken, that often will signal that the market is near a short-term bottom. So when this indicator goes to extreme levels, it often means that you're at a short-term bottom. You can see right here, this is probably the highest level on the chart back here, and you can see that that was a short-term bottom, and the market did go up after that. So it does tend to work that way. Not always, but it is a pretty reliable indicator. Then you get the top industry groups of the day, the groups that move the biggest for the day, and then in the red are the worst performing groups of the day. You got the Dow Jones here, similar chart to the ones above. And then you've got a chart of the IBD Mutual Fund Index. This is an index of the top performing mutual funds and the top I should say the top rated mutual funds by IBD. And then here you get the best price percent change for the IBD 50, and then they call this one IPO best price change. I don't particularly like this wording here, IPO best price change, because these are not newer issues necessarily. Some of these stocks might have gone public, 3-5 years ago. I don't really consider that an IPO anymore, but that's what they call the list nonetheless. So again, I get watch list candidates here. I'll look for the stocks that have the biggest move and the biggest volume change, and then I'll go take a look at the chart to see if it's something I want to put on my watch list. So that's a summary of the big picture. So now I'm going to switch over to MarketSmith. Let's look at the Nasdaq Composite. So I show this every month, and you can see that we've been running, this is March 2009, we've been in this really long bull cycle here, and last month, so this is a monthly chart, this is June right here. You can see that it was a support month in above average volume. So overall it was positive action for the month. Although we're not making new highs, we're not really that close to new highs, but it was a support month overall. But you can see again still, we had this long-term uptrend line which was broken back here in August of last year, and we've just been meandering ever since then. You can see for the past 4 months, really hasn't done much. Market really hasn't moved much at all. So again, it's hard to make big profits because the stocks tend to follow the market action, and if the market's not really moving higher or lower in a big way, then the stocks tend to follow suit. Okay, this is the weekly chart. So the past 4 weeks here, we had last week was a huge support week, and you can see that volume was big here too. In fact, some of the biggest up volume on the chart. So that's positive. Before that, though, we had 3 weeks that were all down, and you can see that they were in increasing volume, which is negative. And this week broke through both the 10-week and the 40-week moving average. But this up week was in heavier volume than all 3 of those, quite a bit heavier. So that's a good sign. On a daily chart on the Nasdaq right now, I'm kind of watching this channel right here. Around 49.70, 49.80. You can see that we've hit resistance here 2 times. So if we get to that point again, I definitely want to be watching that closely to see if it hits resistance again, or if it can plunge through that. If it goes through that level, I'll be watching what happens around 5,000, because 5,000 is just a psychological level. A lot of people will be looking at it because it's a round number. And you can see I marked here we had the British exit vote here. The market, Nasdaq was down 4%, and then the next day it was down 2.5%. And this is a case, you might say, well, who knew this was going to happen? But we did know that the exit vote was happening, and I held my positions through the vote because it sounded like there was a lot of confidence that they were going to stay in the EU, and I kind of expected that move to be priced, that decision to already be priced in to the indices. But you can see that we definitely had a surprise here. Market sold off. Luckily, it's rebounded quickly. I did get stopped out of a couple positions on this day here. And then I went and actually bought one of them back this day and one of them back this day. So kind of annoying to get stopped out of position so quickly, but when the market was showing this action here, I mean, we got a gap up on this day. We got an up day here that busted through the 50-day and 200-day, and you can see volume too. Volume was big on both days. So that's the Nasdaq. Let's look at the IBD 50. IBD 50 is similar action to what we saw in the Nasdaq. these two down days actually look a little better because they're finishing up off the lows where the Nasdaq finished at the bottom of the range. Now, the rebound though isn't so good. This rebound is in volume's very tepid here. Look how low volume is compared to the two down days. So that's a negative sign on the daily. Shows that growth stocks were not as enthusiastic about the rebound as the Nasdaq was. And we'd like to see exactly the opposite. We'd like really the growth stocks to be outperforming the Nasdaq. And you can see here this looks just like on a weekly chart, looks just like the Nasdaq. We've got 3 down weeks, although these are in generally lower volume, and then we've got a support week, but there's no volume. The volume's low here, so I'm not super excited right now about the market, but I'm going to keep doing my swing trades because they take advantage of shorter term moves, and you don't have to worry as much about, did the market run for at least 8 weeks so I could get a good return. Some stocks, I'll just cover a few stocks here. Mobileye, I've really liked this company for a long time. They make technology for the autonomous cars. They sell software and related technologies for the camera-based autonomous cars. And this stock formed an IPO base, went up a pretty good amount here. Then it formed a long cup with handle, and then it went up a little bit, and then it corrected pretty significantly down here. And I've been just keeping an eye on it, waiting for it to really come back above both the longer term moving averages. And it just did that. It actually formed a double bottom base here, which I like double bottom bases. And so I actually bought this stock on the breakout day right here. And I ended up I'm putting tight stops on my stocks right now because the market is a little more choppy and volatile than I prefer. But I did get actually stopped out this day right here because it closed below the pivot here. And then I ended up buying the stock back actually on this gap up day here. The stock actually gapped up pretty significantly because of a news article that they're going to be building an autonomous car with BMW and Intel. I was pretty bummed actually. If the British EU vote didn't happen right here, I would have still had this stock most likely, and I would have captured all of this gap up move. But at least the gap day, it did finish low in the range, so I set my stop to the bottom of this day at 45.29, and you can see the next day it was up on heavy volume, and it held the low of the gap up day. So far this is looking good. This does have a lot of overhead resistance to overcome, so you can see that the high price here is 64, and we're at 47 right now. So that's quite a bit of overhead resistance to overcome. I generally like stocks that are making new highs better than this, but you can see for the week here, 3 weeks in a row really, we've got accumulation, accumulation, accumulation. This week here was accumulation. The down week here was in light volume. This pullback here was very orderly and light volume. So overall, I like this one. And for the week here, you can see it finished high in the range on heavy volume. Some of the heaviest up volume in a long time. So I'm liking this one. You could give it a try right now if you want. And you could set your stop to the low of the gap up day. It's a little extended probably for that, but you could give it a shot. Okay, Mobileye, NetEase. So NetEase, I bought this stock on the breakout day here. You could have used you could have used like a trend line here and caught it a little bit early in the day before it had the actual breakout. But yeah, this had a good breakout. Volume was decent here on the breakout day, and then the next day was very strong right here. So this also had a light pullback when we had the British exit vote. So I bought this one. I still own it. This day wasn't too good here. This day was down in above average volume, and it closed low in the range, but it's still holding well above the pivot here. It also made a new high on this day on heavy volume, which I like. I'd like to see it go back above this point here and hold that high. So we got NetEase, we got Mobileye. Let me just see. I might look at one more here. This stock is a new issue, so if you're not comfortable with new issues, it's totally fine to pass on this one. New issues, I don't really look at the fundamentals too much. I do look at price. So this had an IPO price of 19, right around here. Traded below that for a little bit, which I don't like, but it's trading above it right now. You can see volume is good. We got about 20 million in daily liquidity. That's pretty good for a new issue. And look at sales and earnings growth here. This, you do have some numbers here to work with. I don't look too much at them for new issue, but this company is experiencing positive growth right now, positive earnings growth. 92 composite ratings is really good for a new issue. So I've been watching this one. I bought this one on the breakout day here, broke out of this IPO base, and you can see that since then we've had 2 up days. We had a down day here in really heavy volume, and then this day here was a support day, and then these days, we've had 4 up days in a row since then. And besides that, there really hasn't been much distribution in this base. This is a low volume day. This is a support. This is a low volume. Oh, it's a support day. This is a support day. Low volume. So there's a lot more accumulation in this base than distribution. So I'm liking this one. I'm just going for a 10% gain on this one as well. And if you want to look on a weekly, this you can see the range on this week was really big. It was a wide range week, but it finished at nearly at the top of the range. And this is one thing I really like about MarketSmith. I have here marked this is my stop now and this is my profit goal. So I can see that it's getting close to the profit goal. And my stop is right now is at a 1% gain because it's gone up. It's gone up more than 5% from where I bought it. So I don't want to let a gain turn into a loss there. So I moved up my stop. Initially I had the stop set to $20, which was the pivot point. And the RS line here is just screaming higher, which I like. All right. So that concludes the market analysis. So if you found this video on YouTube and you're not a member of our meetup group, you can join by following the below link. You do need a free meetup account, but it only takes about 5 minutes to set up. And if you're asking why you should join, files like this presentation are posted on the meetup group, and they're only available to members. And I also notify members when a new video or a new file is posted each month. So you don't have to worry about knowing when a new video is going up. I send a reminder out. I also post other files, like I mentioned in this video, the sample quarterly review. That's available on the meetup page, and that's only available to members. I didn't have any questions from the past month from any members, but if anyone has any, please send them over and I'll answer them here. And future topics, I was going to do stock list management this month, but I'm going to defer that to next month. And then next month I want to do 1 or 2 stock simulations, and I'll do those in MarketSmith where we'll actually step through the bases day by day. MarketSmith has a feature where you can change dates and go back in time and see what this chart looked like on a particular day. It's a really good feature for going back and testing your sell rules and how you would have managed a position. Otherwise, if anyone has questions or suggestions for a future meetup, let me know, and I do respond to all my messages on Meetup. Thank you. I hope everyone enjoys the video, and happy Independence Day. I'll see you next month.